to Freightonomics this week. I am head of freight market intelligence, Zach Strickland, here with chief economist Anthony Smith. And we're here to provide you with economic activity, as well as that freight market data and analytics that we provide here so well, and also discuss kind of some relevant topics. The topics of the day, of course, earnings season is upon us. Anthony Smith, and you know that I like to nerd out over some earnings. Former financial analyst, income statements, they do me just fine. But there are some numbers behind the scenes that you definitely have to look into to get the full picture. The earnings will tell you whether something's right or wrong, but they won't necessarily tell you why things are right or wrong. So we've been talking about how a lot of these carriers need to see this market coming. Brokers, same thing. A lot of them have already felt it, but a lot of the large carriers have been relatively immune to the market fluctuations thus far. So we're going to break that down for you here in a little bit. But I think it's kind of a bygone conclusion at this point, right, Anthony? Are we still debating whether or not the economy is slowing or no?
Some people are. So also, it's interesting because I knew it was earnings season, and of course, we do some prep before the show, and I'm like, wait. I might be over prepping because it's earnings season and there's gonna be a lot of stuff to kind of dive into. But it's interesting because there is this story of hey, things are still good because there's such a odd time. You see these offshoots of positivity and strength, and so you want to cling to that and say, hey, there's a strength in the employment market, there's strength in this sector, there's strength in this market. So that defeats all, notion of any type of weakness or recession potentially, and that, a soft landing is still possible. And so it's very interesting to have that mindset. And I'm not saying you're wrong, you're right for having any kind of logic around it. But, from my perspective, we are definitely in a very much slowing trend. And it's concerning that we are in this slowing trend with so many of these other areas being so strong.
Yeah, the jobs market, of course, you've named, but you've also talked about the jobs market showing cracks. If you get into the nuance of the data, a lot of times aggregate information can mask a lot of the underlying support structures that are failing. I mean, cracks in the infrastructure are starting to form, I think, in pretty visible fashion now that we've gone through a few earnings calls and for Q3. Keeping in mind that these earnings calls are kind of lagging. We're talking about what happened in July, here in October to an extent, because Q3 is that 3-month period there. But yeah, I think that'll be, there's some definite interesting stuff coming out of J.B. Hunt and Knight-Swift's earnings that I want to dig into here in a little bit. But first up, Anthony.
Is it time for the market in two? In two?
Okay. I only give two because that's about my attention span. 2 minutes to give you what you need for this freight market update. So, Anthony, if everybody's ready, count me in.
3,
remember how.
2, 1, begin.
All right. The first chart that we have here is our NTI, the National Truckload Index, which is a measure of spot rates and their directionality. And you can see they're not that interesting over the last couple of months. We've been relatively flat in the spot market in terms of rates. Volumes are a different story, but rates for sure, sort of hitting a floor. And one of the questions I've had over the last a couple of weeks is, how much further can they go? Well, looking at the NTIL, which removes the total fuel cost estimate based on 6.5 miles per gallon, it looks like we're not quite on a floor just yet in terms of market sentiment. There's still room to fall. That green line right there actually dipping down where the white line is going up. And it's because the white line includes fuel. So watch out. Fuel costs over the last few weeks have increased and quite significantly and rapidly. So they are supporting the spot rate, the nominal spot rate right now. But the market still says there's a little bit further to fall. However, I will argue that the stickiness of that green line right there suggests that we're already at kind of a floor, and any further erosion is eating into margins, and the ORs are going to go negative into the cost. Let's go to the next one, contract versus spot. Our next chart here, a lot of room for contracts to fall. We had a little bit of support in September. Not going to make a big deal out of that. That looks like a mix. Not a lot of implementations in September. We still have October. I think this index, you just can't sustain this differential. So hold on. So this is still an actual support structure for these large carriers' earnings throughout at least the early part of Q4. So let's move to the next one. CLAV, contract load accepted volumes. This is the index that measures the accepted tender volumes only. A huge amount of a deterioration at the first part of October, but there is hope. And you look at the OTRI, it's going down, but those accepted volumes are actually bouncing and recovering right now.
Oh my, do we have a little bell at the end that you ended
bell.
on? That was impressive by you and the production team.
Yeah, don't expect too much. I mean, that last chart is the ray of sunshine.
Yeah.
The CLAV, accepted volumes, it's really a good measure of, what are these contracted carriers feeling right now in terms of just demand, pure demand. And you can see, yes, there's been pretty bad deterioration this month, but the fact we hit a floor towards the end and it's actually recovering is a good positive signal. That is probably the biggest positive sign takeaway I can give anybody right now with our data, at least. The fact there is some resilience left, and we're not all the way back to where we were in 2019 on that index.
Okay, so when we're looking at overall, so like the first couple of charts that you went into, I mean, we saw some deterioration. We've been seeing some deterioration for some time. Does that really kind of cause like, hey, all this makes sense when we start looking at what these earning calls are saying right now?
Yeah, the CLAV is probably one of the better ones for a contracted carrier, these large fleets, because they're not, they kind of transition out of the spot market. That's kind of their fringe activity, a lot of them. There's some that are pretty heavily spot oriented, but for the Knight Swifts of the world and Schneiders and these larger fleets, most of their volume is handled under contract rates or long-term agreements with these larger shippers, Target, Walmart, Home Depot, et cetera. And so when this index starts to fall, we kind of hit a ceiling last year. You can almost see the theoretical limit of how much they can actually handle in that index. If you look all the way back to 2021, fourth quarter of last year, you can see there was a threshold that was right, we're about 20% lower than that right now. So that's kind of the theoretical limit for how much they can handle. So there's a good bit of buffer in this market right now. And if it continues to erode, that's utilization.
Yeah.
They're not worried as much about those rates on the spot market. They're volatile, but that doesn't represent a huge portion of their volume.
And another thing I have to add real quick, if you catch me looking down, I'm only being a little bit rude. I'm checking LinkedIn because we are streaming live. If you're watching 12 Eastern Standard Time on this Thursday afternoon. And shout out real quick to Roy Bain jumping in and joining the conversation. If you'd like to jump in, add some context, join the conversation, you have a point, anything like that, jump into the LinkedIn chat as well. Roy Bain says companies are dropping rates back to pre-COVID levels. Shippers got hammered during the pandemic, and now it's time for reset rates, and carriers will see drops.
Yeah, carriers they're definitely going to see contract rate drops. The spot market has already fully eroded. I think we're already back. I think rates are already at a floor to an extent. The small carriers have already been feeling it. The large fleets have had some buffer and some room to start feeling this. So let's dig into the news of the day. We've got some pretty relevant topics to cover. The majority of the show, obviously, is going to be built around some of these earnings calls. But first up, Greg Miller writes an article, Container Ship Backlogs Off Ports Finally Winding Down as Imports Fall. We have been talking about this. Henry Byers called this back in May.
Yes.
June, I should say. Imports falling off a cliff article. Yeah, hyperbolic, yes. But at the same time, he was basically saying, hey, look, this is a relevant indicator of what you're about to see. And we've seen it in spot rates for the maritime side. We've already seen significant deterioration there. But it's just taken a little bit longer to manifest domestically. The customs data is kind of limited to the throughput. And this article covers exactly why the customs data has been relatively sticky and resilient in the wake of the bookings volumes falling. This backlog that's occurring around Savannah, it says Savannah, Georgia has the largest queue with 29 vessels waiting. They're clearing containers as fast as they can. It's a backlog, a traffic jam, but aggregate volumes are on the decline. And Savannah, I just checked, Savannah's import bookings they're down over the last month, but that throughput is not allowing them to recognize that decline just yet.
And so this is interesting because, you hear about Savannah, you hear about some Charleston, some of the other East Coast areas and Southeast areas really investing heavily right now into infrastructure to handle all this capacity right now. is this really kind of like, hey, of course, when we think about infrastructure investments, we always talk about, months ago, years ago, it's going to take time to build that out. Do you think this infrastructure investment is going to be well served for them? Or you think it's like, hey, a little bit too late, and by the time, it's going to be really, in place, is it going to be too late? Or do you think it's still going to be beneficial for a lot of the volume to come in the upcoming years?
I mean, it's not the worst thing they could do. I mean, obviously, this is how they're going to be able to grow in the future, and a good reason to invest in it. Get some alternatives and some options. Building out infrastructure is not a bad investment in general. However, it just depends on the cost benefit.
Yeah.
Just like anything. And obviously they're going to be a little late to the game.
Yeah.
The import booms that we've seen over the last 2 years probably not going to happen for the foreseeable future. Not saying ever again, but we're going through a pretty slow period. Definitely check that article out. Oh, and that 29 container vessels waiting is down from 48 in July. That Hapag-Lloyd reported there, but definitely check that out. Now, I'm just going to go ahead and bypass the FMCSA cancels emergency hours of service.
That's interesting.
It's an interesting take. Read the article. I think a lot of people are interested in it, but I want to leave enough time. Maybe if we have time at the end, we'll address it. The market's softening. The waiver canceling, I think, is going to be a relatively non-event in the long run. Short term, maybe a little bit for agriculture, but Mary O'Connell, check out her clip on FreightWaves Now the other day. She covered it pretty well. I want to get into these earnings, Anthony,
Let's
because
do it.
you know it's my thing.
Let's do it. I know this is like Christmas season for you. It comes like 4 times a year.
Yeah, it's great. I love the financial figures and what they tell us. I start off with J.B. Hunt here. J.B. Hunt, an extremely well-run company, and a lot of people kind of, I don't want to say falsely assume that they are a trucking company, but they are more than that. They've got a lot of offerings here. They're not actually, truckload is one of the smallest portions of their business, for-hire truckload, in the traditional sense. They have a dedicated division, which is huge. And that and intermodal are really what they do. And dedicated truckload is basically just saying, you know what, we're going to allocate a percentage of our fleet for you as a shipper to use however you want. You can fill it up. You don't have to fill it up. You pay us a lump sum or a monthly fee or however they want to structure the agreement. And these are multi-year agreements in general. And it becomes like a pseudo-private fleet for the shipper. But it's at a fixed rate, but also it's at a fixed cost for the shipper. If they use the truck or not, they have to pay for it, type situation. And these two sectors really drove the growth for J.B. Hunt. So their earnings per share, 12 cents ahead of analyst expectations, and 69 cents above year-ago quarter. And of course, it goes on to say that they, intermodal and dedicated drove a large percentage of this growth. Dedicated, of course, an extremely intelligent play in this market, because as things are easing, you lock in, like I said, multi-year agreements for dedicated. So you're locking in rates that are close to the peak.
Yeah.
And it's a great maneuver right now. It's a hedge fund of allocating your fleet. You're going into, it's what everybody's trying to do in the financial market right now. Go into CDs, go into, bonds and things that are counter to the market.
Right.
Very safe. Not going to give you high returns, but they are relatively safe. Your utilization stays there. Allocate your fleet over to dedicated. It's a good move. Up $200 million quarter over quarter, which is significant. Year over year, quarter over quarter, I should say. And I want to pull up the intermodal stuff. So I've got an intermodal volume chart. Intermodal, of course, did quite well. Up $400 million, $424 million. This chart right here really helps bring that into play. This is our outbound rail-loaded container volumes for domestic containers, 48 and 53 footers, moving on the rail. And the white line there is connecting the two quarters. So you can see there's a pretty strong jump year over year. September, which was the rail strike.
Interesting.
Yeah. So people forget how quickly people forget what happened last year, which the rail service was really struggling last year. There was so much congestion. They shut down Chicago terminals, domestic intermodal. They couldn't transload anything. It was just a complete mess. So that being said, we're actually having a positive comp quarter, but why did they make so much money quarter over quarter as well? Well, not just the volumes that were actually lower than you would expect. Everybody just applies like this super hot freight market
Yeah.
was applicable to everything. Actually, intermodal was not that great this time last year. But that orange line that I have on there, that is the average contract rate per mile for intermodal. And that's even higher. That's even a better year over year comp. So they got all these rate increases, their volumes recovered. This is kind of I'm not going to say a red herring because it's true that they've improved, but you're comparing the volumes at least to an artificially low situation, and the intermodal contract rates probably not going to go much higher. But this is basically the best comp situation they could get.
And what are your thoughts around the equipment side? So one of the highlights here, nearly 2,000 additional trucks were in service on average in the quarter compared to a year ago.
Yeah, and that's for the dedicated side of things. It's, but their truckload sector did grow. But a lot of that truckload sector, we covered that for their Q2 earnings, actually leased. These are leased on owner operators. So it's not their true assets.
Gotcha.
But they did grow the dedicated division a good bit. So that's a positive. And then, of course, the brokerage numbers were positive, but I want to read a few quotes here. Further evidence has presented itself over the course of the quarter that requires an increased level of caution and awareness on broader demand trends and economic activity. So to your side of things, they're basically saying, watch out.
Yeah.
We know we're catching a bit of a tailwind here. They're definitely nervous about it. And then, of course, the brokerage sector, ICS division, we're just navigating this current environment the best we can. It's a fight out there for volume in the brokerage space, says Brad Hicks, president of Highway Services. And again, it's a volume play at this point. Their revenue came down 75 mil quarter over quarter, year over year. So their margins are still good. Their margins actually are quite high, but their revenue, so their volumes are starting to come down in our road because there's no spot market activity.
Yeah.
We already knew that.
And this is something that they've been prepping, I think. They've been making the right moves for quarters now. And it's always impressive to see how they're moderating and shifting in this shift in the market.
Yeah, but they've got a great book of business. It doesn't just because I'm saying they had a tailwind this month doesn't mean you should just sell JB Hunt by any means. They are well equipped to go into this. They're doing the right things. I give them a thumbs up. They deserve the pat on the back for sure. Even though don't get too excited. It's not the economy's not turning.
Yeah.
They are just managing it quite well, and they also are getting a little bit of a boost from the market itself on the intermodal side. And they're making the right decision on dedicated.
And on the other side, we have a miss here and another company.
Sell. No. Knight-Swift miss expectations. I don't make much of missing expectations at this environment. This is an extremely challenging environment to predict. You have to know a lot of things about what's going on, and nobody knows what's about to happen next. So I certainly don't punish them for missing their earnings here. But let's dive into the details here. A few quotes I want to read out here. It's rare that you go into a fourth quarter and not see some type of seasonal uplift in projects and spot opportunities. We typically get some of these large, kind of difficult projects to handle, and they typically pay a premium. None of that stuff materialized. So Knight-Swift saying not seeing the same environment. And we see that in our data, of course. Knight-Swift did have a relatively decent revenue growth quarter over quarter. And of course, bids can buffer that a little bit. And I think that is a little bit concerning that it wasn't as strong in terms of revenue. So I think they have been seeing some some Really what stands out to me is their deadhead percentage still climbing. It was climbing early on. You could get away with that in the pandemic era, if you will, but up 130 basis points from 13.5 to 14.8%. So they're having to drive further with no revenue hooked to their trailers. Loaded miles per trailer also down, obviously. Loaded miles way down. And just the fundamentals just show them easing. The adjusted OR for the truckload sector up 400 basis points from 77.8 to 81.8.
And I think that was a great point that you made earlier, is that what you could get away with before earlier on in the year and last year aren't going to be the same things that you can do this year. That doesn't just go for large companies. It's especially true for medium-sized and even owner-operators as well, as you're looking at this shifting market. You can't do the same things that you were doing
Right.
previous quarters.
Oh yeah, and this is defensive mode right here. They know they knew this was coming. They can feel it now. Their OR, again, dropping to an 81, or I say increasing to an 81 from a 77. That's a big jump. It's an alarming jump. But I mean, the fact that we're even still talking about an 81 OR, there's a lot of room here. They've got some room to breathe, even as the market kind of fades on them. Now, big call out. Knight-Swift has made acquisitions. Obviously buying ArcBest here, or not ArcBest, AAA Cooper. They're in last year, and we finally have the year-over-year comps. Huge growth here. 33% year-over-year revenue, excluding fuel, jump in the LTL side of things. Shipments per day up. Weight per shipment up. Or no, that's slightly down, actually. But their comps here are extremely positive for the LTL sector. And we've been talking about the LTL sector, my old stomping ground, having a tailwind longer than the truckload sector.
Yeah.
We've got a few things going for it. One, let's pull up this chart that I have, TL versus LTL. These are the contract rates for van truckloads versus LTL, less than truckloads, contracts, and a revenue per hundredweight. It's a lot more volatile because freight mix in LTL is much more dependent on density and weight and miles driven. So you have a lot of spikes here. But the overall trend is still to the high side. They're able to get rate increases. It's a slower cycle for them to feel the truckload changes. And you see the contract rates for truckload there in white not falling as that fast just yet. So it takes about 6 to 9 months for LTL to actually start reacting and feeling a lot of these truckloads. Now, beyond that, there's structural things for the LTL market, such as the warehousing space. There isn't any. What are you going to do? You got to buy smaller stuff to get to that storefront. All this old inventory, you got to navigate around it. What's the best way to do that? Expedited and LTL.
And what about, can you also talk to about just shifting goods from warehouse to warehouse to warehouse? Is that also going to be a big factor here?
Yes, and a lot of what we're seeing right now is these just upstream warehouse movements. We've seen the short haul stuff really increase over the last year. This is inventory management central right now. People are basically, trying to just move stuff into the right places, old inventory into new inventory. That's what's driving a lot of the freight volume right now, honestly, is that upstream stuff, because replenishment's still a thing. Long haul volumes are still up relatively decent. They're holding pretty strong, but that tweener, those loads that are moving between about 250 to 800 miles, it's kind of fizzled out.
Yeah, I think that's a great point. We're talking about inventory levels, because inventory levels still up, still very much elevated. Of course, that's going to mean warehouse capacity tightens up and warehouse prices get higher and higher. And the big thing about it when we're thinking about inventories, of course, we talked about upstream inventories piling up. When we're looking at manufacturing, industrial production, they're still very much elevated. And we're seeing new orders get canceled now, potentially.
Canceled orders.
They're getting canceled.
We're seeing such a lag in terms of activity here. Like, we're seeing a lot of quick stuff. We have obviously very fast data that we look at every day. And we're kind of like, oh, there it is. There's the movement. But operationally, it takes time for these things to kind of stroll through the system. I wanted to have one quote here, and this is the most telling quote of this entire article. Todd Maiden does a great job covering these earnings. I highly suggest you read them. CEO Dave Jackson said, "We expect meaningful, attractive acquisition opportunities over the next few quarters." Read between the lines, Anthony Smith. Tell me that doesn't say this market has deteriorated and we expect it to really hit these small fleets hard.
Yeah, I think that's spot on. And I think, it's just so much congestion and so little meat on the bone to grab from it. And I think he put it in a very eloquent way on the call here. But one of the other big things I think people are looking at, especially with all the congestion going on, is still, we got to get Zach Rogers on here.
Oh, yeah.
I think we have it set up, and I think we're going to get him on soon. But work in process goods as well, also clogging up inventories, as well as finished goods. And I think that's going to be a big aspect for a lot of folks, and especially when we look at automotive and things like that, those industries. we're seeing waves of stuff come out, then you don't hear anything, then waves of stuff come out again. I think it's going to be that work in process that also throws a lot of folks for loops.
Yeah, automotive is still having, a little bit of a tailwind here.
Yeah.
They've been slow to react, like an industrial kind of mini boom that we saw at the end of the pandemic era is still working its way through the system. So you really have to, there's a lot to know. There's a lot to understand about this transitioning space. So
Zach, for the good folks watching us,
let's do it.
they're used to us being on at 12 Eastern Standard Time on Thursdays, but we're moving to 11:30 in our next episode.
Yeah.
So if you're used to watching us at noon, just move it up 30 minutes. Potentially, we appreciate it, but we'll be starting at 11:30 next time.
You can still download it on your favorite podcast player or YouTube or whatnot. But that'll do it for us for this week. Y'all have a great week and